Hi, this is Crooks from Money and Markets TV. Since the global financial crisis a few years ago, central banks around the world have embarked on an unprecedented money printing spree. These easy money policies haven't succeeded in boosting the real economy. Instead, they've just propped up asset prices and increased debt to unsustainable levels. The economists Carmen Reinhart and Kenneth Rogoff have defined a debt-to-GDP ratio of about 90% as the threshold at which growth in developed economies begins to falter. In emerging markets, it's considerably lower than that. Now, the debt-to-GDP ratio in the United States and many European countries is well above that 90% mark. In response, the Tea Party here in the U.S. has made a big push for austerity. But in Europe, austerity policies have already been implemented, and we're beginning to see the consequences. The harsh push towards fiscal prudence has hit Greece's economy especially hard. Other Eurozone economies are also under severe strain as growth slows, and that's resulted in a backlash against the policies imposed by Frankfurt and Brussels. But the truth is, Greece should never have made it into the Eurozone to begin with, and the same goes for Italy. Neither country met the criteria established by the founding members of the club. But France wouldn't join without Italy's participation, and politicians wanted to include Greece to bolster the spirit of the new union, so they bent the rules. In fact, Europeans have come to believe that their leaders will always bend the rules. They have continually put off the tough decisions, kicked the can down the road, and postponed the ultimate day of reckoning. They keep printing more euros and taking on more debt, and hoping that the problems will correct themselves. I expect this trend to continue for a little while longer, until they run out of options. In the meantime, the face-off between anti-austerity voices and Germany is growing tenser. Germany doesn't want to perpetuate the spending spree of Eurozone governments, because it fears that the underlying debt issues will never be resolved. And Germany's opponents don't want to suffocate their economies in the name of austerity. At some point, the viability of the common currency will be called into question. It's been clear to me for a while that the euro has prevented much-needed economic rebalancing within the Eurozone. Now, more analysts are predicting that Greece will have to abandon the euro to repay its debts. Over time, the euro will come to be seen as an impediment to an economic recovery in the Eurozone. And as that happens, its value will decline. I'm Crooks for Money and Markets TV. Thanks for watching.